and I will introduce Paul McEnroth, who will be doing the presentation. Paul is one of our senior solicitors who works in our Brisbane office, predominantly servicing clients in Queensland and northern New South Wales. His experience is broad, and he works with all various types of our clients, but particularly enjoys the complex estate and succession planning, which we're not talking about today. We're talking about trust, which obviously can be used in estate and succession planning. But I'm going to pass you over to Paul, who will be presenting our webinar today.
Thank you, Adrian. Thank you, everyone, for attending. I am going to be talking about one of my other favourite topics today, and that is trusts. We're doing this as a series on trusts. So today we're going to talk about the basics of trusts, but in some later sessions we're going to talk about taxation of trusts and various strategies to, I guess, protect and utilise trusts in a protective environment. There are a lot of slides today, and we did start a little bit late, so I'll try to keep flowing through, but please ask any questions you might have as we go along. So as I said, today the agenda is really talking about the basics of trust. So what is a trust? What are the different types of trusts? We're going to talk about a common area of angst among accounting professionals, and that is trust variations and resettlements and how to avoid them. So we often talk, particularly in the tax world, but more broadly, we talk about a trust as if it's a living thing. We talk about it as if it's an entity, but it isn't. It's not a separate legal entity like a person is or like a company. What it is a relationship between the trustee, the trust property, and the beneficiaries. And it's a relationship of trust. So the trustee has a relationship of trust binding those three elements together. Now that's kind of a bit of a loose description and often difficult to explain to clients. But really what we need to understand is that even though we might talk about a trust, it is really often the trustee that we're talking about, and they have a range of obligations that they have to uphold in that trust. And we're going to talk about what those obligations are today. So the concept of fiduciary relationship, it doesn't really have a clear definition. It's been talked about for centuries in the legal world in various cases, but basically it can overlap amongst a number of other different types of relationships. It can overlap with contractual relationships, but essentially, if we boil it down to really simple terms, a fiduciary undertakes to do something to benefit someone else and not cause detriment to that person. So in our context, we're talking about the trustee, as I said, who holds trust property for the benefit of one or more beneficiaries, and their obligations are to benefit those beneficiaries and not cause detriment to them. So when we look at discretionary trusts, again, there's no definition. It's something that can take many different forms, and it's a descriptive phrase that we use to cover a broad range of trusts. So we often use the term family trust interchangeably with discretionary trust, the difference being obviously leaving aside the tax description of a family trust, but it really is a discretionary trust held for the benefit of a family. So again, it is that descriptive phrase, and it doesn't really give great meaning to describing what that type of trust is. What it generally means is that there is often complete discretion given to the trustee in relation to how that trustee distributes income or capital of the fund among a broad range of beneficiaries. And that discretion is where obviously discretionary trust gets its name. So again, in practice, what happens is we have a trustee who is the legal owner of an asset. That might be shares in a company, might be units in a unit trust, might be real estate. But that trustee holds the title for the benefit of a range of beneficiaries. Now, we will often see a named beneficiary in the trust, and then very broadly, the beneficiaries then branch off that named beneficiary. Generally, the named beneficiary is our client. We would set up a trust. They might even be the trustee themselves or have a company that they control, and they would be the primary beneficiary. And then there would be a class of beneficiary that branches from them. So, for example, their children, grandchildren, and great-grandchildren, siblings, for example. Again, one of the common questions we have of having that broad range, including siblings, for example, is, well, do they have any rights to the assets in that context? And the answer is no, and we'll talk about why later on. But some of the basics, the first basic is what's called the rule against perpetuities. It's a centuries-old rule. It's now in legislation, but for the longest time, it was brought in when knights in England were heading off to war. They would put their land in trust and put a trusted advisor as the owner of that land in trust for their families. Now, the king at that time, there were death duties around that time, and when a land would pass from father to son, as it generally was, there would be duties payable. Now, the king brought in a rule which said that land could not be held in perpetuity in a trust-like fashion. And the reason for that was, again, a tax reason. They wanted the land to pass from one person to another and therefore have death duties imposed. So the public policy behind it was that land or assets should not be indefinitely suspended from vesting in a beneficiary. And it should not allow for the indefinite accumulation of income. Now, that rule still exists, but it has been replaced in Australia by legislation, which has brought in an 80-year rule. So most modern trust deeds now, since the legislation was enacted in the 80s, has an 80-year rule. So a trust must vest or end at the end of 80 years from its start date. So we now have what's called a wait and see rule. So obviously, the wait and see rule is basically we wait to the end of the 80-year period and determine whether there are beneficiaries alive at that time who can get the asset. We don't need to draw up a list at the beginning of the trust with all of the beneficiaries who might be alive at the end of the trust. Which was one of the inherent failures in the old system, was that you kind of had to know that there would be a particular person who would be alive at the end of the trust. And generally, all of the old trust deeds had language that referenced the king and his heirs and so on and so forth. So now we have an 80-year statutory period in which the trust will come to an end, but we wait until the end to determine and make sure that we have beneficiaries who will receive the assets. So when we talk about discretionary beneficiaries, we're going to talk about some of their rights and the obligations of the trustee. But discretionary beneficiaries have a right to be considered for a distribution of income or capital, and no more than that. It's probably better to describe that right to be considered as a right to ensure that the trustee is adhering to its duties. So a trustee has an obligation under most trust deeds to consider which beneficiary in each year will be the recipient of a distribution of income, for example. So if a trust generates income at 30 June, the trustee must determine who that trust or that trustee will distribute that income to. Now, the beneficiary has no, in a discretionary trust, has no power to go to a court and demand that income be distributed to them. What they have is a right to go to court and ask the court to ensure that the trustee is administering the trust according to the rules of the trust. So one of the rules you'll always hear when talking about trusts is read the deed. One thing I learned, it took a little while for me to understand this when I started in the law, was that there's no one set of rules that all trustees must adhere to. And that kind of seemed a bit strange to me, and maybe why it took a little time for me to understand was that, I was brought through the law school learning about here's the legislation and these are the rules that have to be followed in that legislation. And then I found out that trust deeds can be written in any way you like. They don't have to have one set of standard rules. So it's very important whenever you're doing anything with a trust is to read the deed so that we understand, well, what are the particular rules of this trust? And I had an example just in the last couple of days where an accountant rang and wanted some advice on making a distribution to a corporate beneficiary. And when I read the deed didn't allow for the introduction of the corporate beneficiary that they wanted. In most cases, that would be an ordinary transaction, a distribution to a corporate beneficiary with a trust as the shareholder, and that trust is related to the original trust. That would be an ordinary transaction, but reading the terms of this deed, it didn't allow for that to occur. So it is important to always go back to the deed. So these are some of the duties that are placed.
Sorry to interrupt.
Yeah.
Just a question from the floor. I understand South Australia has an exception to the 80-year rule. Is this still the case? If so, what are the benefits and why do they allow it compared to other states?
Sorry, you're right. So there is an exception in South Australia where they don't have the 80-year rule. So effectively, the law in South Australia says that if there is a document that should have, there is a rule against perpetuity under the common law, that rule is excluded. So basically what that means is you can have a trust go on forever in South Australia. Now, one of the things that we've looked at over the years, and the answer is not terribly clear, is whether you can perhaps change the jurisdiction of a trust to South Australia and therefore avoid the rule against or the 80-year rule. The answer is not clear. I've seen writings on both sides of that argument, and both sides are compelling. The answer often is, well, if you don't have any assets in South Australia and you're just trying to use their law, probably the preferred view is that that's not going to help. But if you do live in South Australia, you have assets in South Australia, then the 80-year rule won't apply to your trust. I hope that answers that question.
Thanks, Paul. Nothing further. I just will add the comment that even in South Australia, after the 80-year period, the beneficiaries can apply to wind up the trust. So it's not definite that it will be there forever. I'll throw back to you, Paul.
Thanks, Adrian. So these are the duties we're going to talk about today. These are the trustees' duties. So adhere to the terms of the trust, and we've talked briefly on that. They must act impartially. They must not fetter their discretion. Now, it's a legal term which is something to understand, but when you mention the word fetter to anyone other than lawyers, their eyes probably glaze over. They have a duty to account to their beneficiaries. They have a duty not to delegate and not to profit. So we'll talk briefly about each of those duties that a trustee must follow. So probably the most important duty is to follow the terms of the trust deed. So again, trustee has an obligation to understand the terms of the deed and follow them. Most duties can be modified, but this one cannot. There are some qualifications. Now, the aspect that Adrian just mentioned about beneficiaries going to a court and asking for that trust to be wound up is based on the rule in Saunders and Vautier, which is an old English case, which basically says if there are beneficiaries who are of sound mind and legal age, who are entitled to the assets of a trust fund, they're entitled to call for those assets to be transferred to them. Now, in most discretionary trusts, that will not apply. So a discretionary beneficiary won't be able to go to the court and ask for the court to make an order to transfer them assets. But this rule comes out of trusts generated under a will. So you'll often have clients who say, oh, I don't want my kids to get those assets until they're 25. Well, there is a simple trust that is created in that scenario. But if the kids get to 20 or 18 and realise that they can ask the court to give them those assets, if there's no reason against it, being age and soundness of mind, then a court may order the trustee to pass those assets on to them. Obviously, a court order will trump all duties or powers under the deed. So if a court orders it, it will happen. They have a duty to act impartially between beneficiaries. So the history of this is based on trusts in wills. So you might have what's called a successive interest. So a trustee may hold an asset for a real estate asset where one person gets to live in that asset for their life, which is called a life tenant. And then once they pass away or move out of the property, then the asset goes to what's known in the law as a remainderman, effectively the true beneficiary. Now, where some fights have happened in the past is where the benefit or the trustee is looking to benefit one beneficiary over the other. So in that case, both would have an equal right under that trust, an equal right for the trustee to act impartially between them. So often it's about allocation of expenses. So if an asset was being run down, for example, well, that might benefit the life tenant who has to pay those expenses, but it doesn't benefit the person who ultimately gets that asset because they get an asset that is run down. And obviously, if there's a distribution between income and capital, so you might have a particular person who is entitled to all of the income, but another person who's entitled to capital. Now, these are fairly obscure and not common type scenarios, but they do come up. So these things do apply to all trusts, but it is a bit difficult to express this in the terms of a discretionary trust because at the end of the day, all of those beneficiaries are purely discretionary. And there was a case, which is Edge's case, which talked on about this particular duty. And what it comes back to again is following the terms of the trust and the purposes for which that trust were established. And really, it is again a branch of that first duty. So they really should follow the terms of the trust deed in administering the trust and acting impartially amongst the beneficiaries. So a trustee has a duty to not fetter their discretion. Essentially, what that means is you can't make an agreement that at some time in the future I will act in a certain way when when I might have a discretion at that time. So an example of this might be I make an agreement that I'm going to distribute income from this trust to one particular beneficiary for the next 5 years. What that does is, in those subsequent years, it may be okay in the current year, but in those subsequent years, if a trustee were changed, for example, that trustee would be bound by that contract to distribute income in that way. And a beneficiary or even that new trustee could go to the court and apply to set aside that contract, because a trustee has a discretion each year, and you can't agree to fetter or cease that discretion in a later year. So again, it will come back to the trust deed. So the trust rules say every 30 June you have to consider the range of beneficiaries and make a distribution. Well, if I make a contract that I'm not going to do that and I'm just going to distribute in a particular way, well, that breaches essentially the first three duties we've talked about. A duty to account involves oftentimes the provision of certain information. So if assets or if income or assets are to be distributed in a particular way, well, a beneficiary may have a right to the provision of information about how that distribution occurred, about who it went to. So at the end of the day, when oftentimes in a family court setting, lawyers will want access to information about how distributions occurred, and it will be a matter to determine whether or not this duty to account applies to those, to the beneficiary, and therefore do we have to provide information to those lawyers about things that happen in relation to the trust. Now, this really is more about trusts where beneficiaries have what's known as a proprietary interest. So they have an actual interest in the asset of the fund. And we're more talking about a fixed trust rather than discretionary trusts. So in relation to discretionary trusts, there's an old case. A lot of these trust cases are old cases, but there's an old case called Gartside's case. It was an English revenue case. And essentially it said, well, beneficiaries of a discretionary trust don't have proprietary rights in the assets, and therefore making an appeal to those proprietary rights can't happen because there are no proprietary rights. So therefore there is no right to disclosure of information from the trustee to those beneficiaries. Now, the court may, in its inherent jurisdiction, step in and order the provision of information. And again, if a court orders it, we do it, obviously subject to appealing those decisions. But again, the court may look at, well, is there an obligation under any of the other duties, not necessarily this duty, to give information to a particular beneficiary. And oftentimes it'll be that first right. So is it important to give information to a beneficiary for that beneficiary to weigh up whether the trustee is adhering to the terms of the trustee? So the next duty is a duty not to delegate. So the trustee is under a duty not to delegate their job as trustee to anyone else. Now, most modern trustees have written in their terms the power to do this. So oftentimes this will be disregarded because a trustee can do away with this duty, but most trustees have a power to delegate certain duties. But ultimately, you can't delegate every duty. You can't delegate the duty to adhere to the terms of the trust, for example. You might be able to delegate an investment duty, but Again, it's about looking at the terms of the trust and making sure that we have the power. Duty not to profit. So a trustee has a duty not to profit from the trust fund. Now, obviously, again, there are certain aspects where, say, for example, the trustee may be empowered to receive an income, for example. Well, that's not what we're talking about here today. We're going to look at a case only because it involves well-known and rich people. So we're looking at the Murdoch case. And in that case, Rupert was the trustee for a number of trusts set up by his father, Sir Keith. Dame Elizabeth, who was Sir Keith's wife and Rupert's mother, was a life tenant in relation to income from those trusts. So essentially, she got the benefit of all the income from those trusts, and other beneficiaries received the capital benefit once Dame Elizabeth passed away. So again, that's the third point. Rupert was the remainderman. So Rupert, as trustee, invested in News Group, of which he was the CEO. And strangely, Dame Elizabeth derived more income than she had previously, as a result, probably many years ago, of News Group or the news industry generally being profitable. But Dame Elizabeth sued the trustees sued Rupert for breach of trust. And she said that the investment favoured capital growth over dividend rights. And there was a duty upon Rupert as the trustee to account for his gains in relation to benefit that he received from that investment. Now, the matter was settled for about $85 million. And what this fight was actually about was whether the settlement amount was income or capital. So it wasn't actually about part of it was about the duty, but the case was really about whether it was income or capital. But it's an interesting observation, one, into a rich family's life, and one can only wonder what the true reasoning behind this case were. But you can see that if a trustee favours themselves in this case over the benefit owed to a fixed beneficiary, they may have to account for that. So other duties which we won't go through here in detail are duty of reasonable care. Loans to trustees are generally prohibited. Mixing of trust funds. So if you're a trustee for more than one trust, you, as a matter of practice, should keep the money separate. But as a matter of general law, you shouldn't mix those funds anyway. But again, these are unless authorised by the trustee. Now, most trustees allow for loans to trustees and mixing of trust funds. So they are getting a little bit old, but again, read the deed. If the deed doesn't allow it and the trustee has done it, then they will be in breach of their duty. But again, that duty that they cannot profit remains. You can't write yourself out of that duty. So when we're talking about trusts of a discretionary nature, we're talking there's often what's called a default beneficiary. What that means is if a trustee at the end of the income year or at the end of the life of the trust doesn't distribute income or capital, then a particular person, usually named in the deed as a default beneficiary, will receive that income or capital. Our trustees don't have a default beneficiary because we favour asset protection over that taxation flexibility. But what these default beneficiaries have is what's known as a contingent interest in the trust fund. So their interest is contingent upon the trustee not fulfilling their duty to distribute income in the year. That contingent interest is a proprietary interest, and we talked a bit about proprietary interests earlier. So the question then remains, well, do they have a higher right than a purely discretionary beneficiary? They probably do. They probably have a greater entitlement, albeit that it's still not. It's still a low right, but they have an entitlement to information. For tax purposes, if we were to, for example, transfer our benefit under a default beneficiary clause, it would be very difficult to quantify that value. It would probably have a negligible value, if any, but it is on the table in those fights. If we were having a fight about the rights of a default beneficiary in relation to a trust. So as I said, we don't have any default beneficiary clauses in our deed because we want a fully discretionary discretionary trust. And what that means is no beneficiary has any proprietary rights, contingent or otherwise, and the only right they have is a mere expectancy, which is a term at law, which basically means I'll be standing around hoping the trustee might give me something from this trust. Again, we have a right that the trustee discharges their duties and follows the terms of the trust. And even if we were to go to court and try to get a trustee to act in a particular way, it's not going to be effective because our rights are so minimal. So if we talk about a different type of trust, we have unit trusts, and there are different forms of unit trusts. So a unit trust will have the same elements. It will have a trustee, it will have trust property, and it will have beneficiaries. The difference between this and a discretionary trust is that the beneficiaries, who are called unit holders generally, will have a proprietary right in all of the assets of the trust fund. Generally, the property at the beginning is the subscription amount, or sometimes a settlement sum, depending on your where you get your trusts, and any other assets. Obviously, the trustee buys after that. So, as I said, the beneficial interest in the trust is divided into units, similar to shares, and essentially the unit holders then have a proportionate right to income and capital from that fund, again, depending on what the terms of the trust deed say. In terms of some tax issues with unit trusts, you need to be careful of CGT event E4. So if we were distributing, income and capital from a capital gain, where the trustee might have accessed small business concessions, you can have a separate CGT event E4 in relation to the untaxed portion in the trust. So that's something to be wary of. And it's not necessarily a fixed trust for the trust loss measures. So we know that for trust loss measures and franking credits, flowing of franking credits, our trust needs to either be a family trust or a fixed trust. And often unit trusts won't satisfy the criteria of fixed trust that the Commissioner puts forward. And asset protection. If we were to have unit holders in this trust who were individuals, well, again, we don't receive the asset protection benefits because that individual who might go through bankruptcy, well, the trustee in bankruptcy may end up owning the units in that unit trust, which significantly erodes that asset protection. So our unit holders should be discretionary trusts. So a hybrid unit trust is a combination of a unit trust and a discretionary trust. The unit trust will have unit holders and income and capital from that trust will flow to those unit holders in proportion to their units. So if you have two unit holders with equal units, they'll receive income and capital equally amongst them. But the trustee has the power to make a discretionary distribution to other beneficiaries. Now, that power is always with the consent of the unit holders. So the unit holders would have to consent to the distribution. But we also have that power to distribute to discretionary beneficiaries. The reason you might use a hybrid unit trust over a unit trust is to avoid that problem we have with CGT event E4. So if we make a distribution using the hybrid provisions or the discretionary provisions in our trust deed, then CGT event E4 doesn't apply to that distribution. So we can circumvent or skip that CGT event occurring. Again, probably the most important part is it doesn't happen without unit holder consent. So the unit holders, if they don't want to, if one or the other doesn't want to consent to a discretionary distribution, then it won't happen, and the unit holders will receive the distribution. So the final part is talking about trust resettlements, and it's a common thing. It's a common question I have with any type of work. Sorry, Adrian.
Sorry, before you get into trust resettlements, just a quick question. When a hybrid trust is initially set up, does it have to have unit holders?
In theory, no, because it would probably be a discretionary trust in that way. But how would you get consent? I think the answer is probably yes. In theory, you could probably do it without it, but the answer would be yes, that you should have at least one unit holder. You could probably change the terms of a standard trust, a standard hybrid unit trust, to allow that concept to occur, where you could bring them in later, but that would need to be, I guess, a bespoke trust deed rather than an off-the-shelf.
Thanks, Paul.
Okay, so trust resettlement. As I said, any type of work we do with trust where we might be varying trust, invariably the first question out of the accountant's mouth is, will this be a trust resettlement? And it's an often misunderstood term, trust resettlement. I think it's better described as the creation of a new trust. Will this act that we're doing bring to end one trust and start another trust? And I think if we describe it that way, oftentimes we can be a little less afraid of making changes to a trust deed, for example. But a trust resettlement can be done by a couple of different ways. One is distribution of an asset to a new trust. So we're moving an asset from one trust into a new trust. Well, that's clearly a resettlement of that asset on a new trust. We've brought to an end the trust over one asset, and we're now holding it on in a separate trust. And the other is a variation of the existing trust, which causes most questions. So as I said, obviously, if we make a capital distribution of an asset, shares, for example, from one trust to another, well, that's clearly going to be a resettlement, probably better described as CGT event E1 or potentially E2, which is the transfer of an asset to a trust. Obviously, we need to be aware of that rule against perpetuities. So if we're transferring an asset from one trust, obviously in a closely held group, to another trust, we need to make sure that we're not going to inadvertently circumvent that rule of the 80 years. So if I have a trust started today and it's going to last for 80 years, and I start a trust in a week's time, if at some point I transfer the asset from Trust 1 to Trust 2, well, I may be circumventing the rule against perpetuities because that asset actually has an 80 years plus 1 week life by doing that. So oftentimes when we're doing this, we might limit the vesting date to the date of vesting of the first trust. So that's one of the little traps. The other is Division 7A. So if we're making a capital distribution from one trust, we need to make sure that there are no unpaid entitlements to income in favour of a company. So in that case, we can trigger subdivision EA or EB of Division 7A and have a taxing event on that capital distribution. So the one that causes most problems is variations to the trust deed. So the variations might take these different forms. So adding new beneficiaries, some what are known as Bamford amendments. So after the High Court case of Bamford in about 2010, and the ability to stream capital gains or frank dividends, and issues surrounding net income. Interim capital distributions is another. So oftentimes you may want to, as in the scenario I just mentioned, where you want to distribute an asset from one trust to another. Some deeds don't allow you to do that unless you're bringing to end the first trust, and we may not want to do that for a number of reasons. So we may want to vary the trust to allow an interim capital distribution, or we may want to hybridise a standard unit trust to allow for discretionary distributions. So what's required in order to vary a trust deed? Well, the first thing to look at is we need to look at, is there power in the deed to allow us to vary? And does that variation cause there to be such a fundamental change in the trust that it terminates one trust and starts another? So there's been a number of cases. The two we're going to talk about today are the two, most seminal cases, the first being commercial nominees and the Commissioner of Taxation. And this involved a super fund deed that was varied to broaden the category of employees who could participate in the superannuation fund. Both cases relate to carry forward losses of a fund, of a super fund. So what they said was, well, what you've done is you've ceased one super fund, and a super fund is a trust, just by a different name. You've ceased that trust and you've started a new trust, and therefore you don't get to carry forward your losses that you made in that earlier year. And what the High Court unanimously held in that case was that there was three main indicia of continuity of a trust, so that trust continuing. And that is the constitution of the trusts, and that is essentially the rules of the trust, the trust property, and membership. And what they said was that changes in one or more of those things, so if you change the trust property, for example, you sell one asset, you buy another, well, that doesn't terminate a trust in and of itself. If you change the members, particularly in a superannuation context, or probably a broadly held superannuation context, members come and go. Well, that change in membership doesn't terminate the trust and start new ones each time a member comes along. So unless there's something that's so fundamental that changes those three things, then the trust will have continued. There will not be a destruction of that trust and the creation of a new trust. So that was again confirmed in another case, which was another trust loss case, and that was called Clark's case. And basically, in Clark's case, it was it wasn't a superannuation fund; it was a unit trust. And in that case, there'd been a number of changes of unit holders to the point where earlier unit holders were no longer involved at all in the business. And the unit holders who were the current unit holders hadn't been involved from the start, so they came along. Perhaps even if you thought about it say Cleary Hoare, for example, in a unit trust context there, well, the principals who started the firm way back when, they're no longer here, and the current principals are not the same unit holders as they were. Well, that didn't result in a resettlement or the creation of a new trust. So in that case, there was a change of trustee, there was changes of controls of assets, there were changes in the trust assets themselves, and there were a change of unit holders, and none of those aspects, when put together, caused the ceasing of one trust and the starting of a new trust. And that resulted in Tax Determination 2012/21, which sets out the Commissioner's view on trust resettlements more broadly. So when we look at a trust deed, we look for the power of variation. And this is a narrow variation power. And it's probably a little bit using sort of a little bit of older language because they were a little bit narrower back then. And what the wording of this says that trustee may at any time and from time to time by deed, so they have to create a deed, vary the trusts hereby declared. So when I read that, what that means is I can only vary the trusts that are already in the deed. So I can't add new ones. But then there's some further words. It says, by appointing in favour of any child, children, or other issue of the appointer, in addition to or in substitution of the said beneficiaries. So that seems to limit it even further to be a variation based on distribution to children or addition of beneficiaries. So the next deed is a broad power of variation, and this comes from our trust deed. And basically it says subject to any specific restrictions in any clause. So we often might, in a bloodline trust, for example, we would restrict a power of variation in relation to that, those particular clauses that make it a bloodline trust. So you couldn't come along later and make it, take away those features that cause it to be a bloodline trust. But essentially, our clause says, subject to those restrictions, the trustee may revoke, add to, release, delete, or vary all or any of the trust powers or provisions contained in this deed and anything in any subsequent deed that we might have done a variation of. So if we varied a deed, we can also then vary that variation. It gets a bit confusing there. So you can see the difference between those two clauses. And the first one is from a real trust deed that came across my desk. And obviously, as I said, this is ours. So this would allow for practically any variation to a trust deed that we might want to do. So obviously, getting this wrong does have severe implications. So if we cause a resettlement, it causes a CGT event. So if we have an asset, a real estate, for example, in a discretionary trust, and we cause a resettlement, we might have a CGT event in relation to that asset, which is taxable, depending on obviously the cost base and the market value. But obviously we haven't sold it to anyone, so we don't have any money generated, but we might have a tax bill. Obviously, in relation to trading stock and depreciable assets, well, there's other implications there if we have a trust resettlement. And for stamp duty purposes, if it were a real estate asset and it were a declaration of trust, which is slightly different and has specific wording, we might have a declaration of trust over property which is dutiable. I am getting towards the end of my time. I will briefly go through these slides. There's two concepts, trust cloning and trust splitting. And basically a trust clone is where you clone trust one and you move the asset from trust one across to trust two. The benefits of doing this, it will be a CGT event, but we don't in Queensland have stamp duty on that transaction. We may be able to use some other type of rollover depending on, I guess, the particular circumstances. But we often use this scenario where we may want to move assets to different trusts for estate planning purposes, sometimes in relation to land tax or other issues like that, or maybe just asset protection. So often we use this in a Queensland context because of the lack of stamp duty if we do it with a particular process. Trust splitting has become, I guess, a bit more topical because of a tax determination late last year on trust splitting, which I don't completely, well, I don't agree with much of it, but I don't know that it's certainly helped everyone's understanding of trust splitting. But essentially, trust splitting is where you might appoint a separate trustee in relation to a separate part of the trust fund. So you might have two assets, one being shares and one being real estate. You want to appoint a separate trustee for the real estate and a separate trustee for the assets. What I will say on this is that trust splitting is still possible. It's still a genuine use of for estate planning purposes, and the tax determination does give us some, I guess, guide rails within which we can stay to allow our trust split to occur without a CGT event occurring. We may be able to vary our unit trust, as I said, to a hybrid unit trust to allow discretionary beneficiaries. This can be done without CGT and without duty. But again, it comes back to the power of variation in our deed. So in wrapping up, again, in a fully discretionary trust, no beneficiaries have any trust interest in the assets. Therefore, their rights are really limited, and that's why they hold such benefit in an asset protection context. When we're looking at establishing companies, we should be making sure that the shareholder is a fully discretionary trust like our bloodline trust or a discretionary trust. If you're using trusts that have default beneficiaries, I'd recommend considering whether you should change your provider and going away from deeds that have that default beneficiary clause. Again, the other aspect, obviously, if it's a unit trust, well, we need to make sure we have a fully discretionary trust as a unit holder. So thank you. I know I'm a little bit over time, but happy to take any more questions that you might have.
Thanks, Paul. We'll stop recording the webinar now. So if you do have questions, feel free to ask them